You are listening to the Money Buddy podcast, brought to you by Money and Me, an investor education initiative by PGIM India Mutual Fund.
Hello everyone, welcome to a brand new edition of Money Buddy, our very own podcast series from PGIM India Mutual Fund and an investor education initiative as well. On this podcast series, insights on personal finance are made easy. Now, what do we have in store for you on today's podcast? Well, you know the age-old saying, don't put all your eggs in one basket. You see, investing is all about cutting down your risk by diversifying your investments. And this is a really key aspect of asset allocation. What we're going to be exploring on Money Buddy today is protecting and growing your wealth with asset allocation. And we have with us Ajit Menon, CEO, PGIM India Mutual Fund, who's going to be talking to us all about it. Let's dive in.
Hi, this is Ajit Menon again, and I'm happy to be back with Money Buddy. I'm going to be speaking to you today on one question that I keep getting when I'm traveling and meeting audiences. And it doesn't matter if these audiences are about in their 40s or 50s, or if these are younger audiences. There's always this question that sort of comes to me, and which is that, we hear a lot about things like asset allocation, and what is all of this? How does it help? And why should we be even thinking about things like asset allocation? All we want to do is protect our money, in fact, increase our wealth. And those are like two objectives that most people have. And so what's the best way to really do this? Isn't there a simple way that one can go about thinking around it? And so, I'm not going to be able to tell you how to make money so easily, but what I am going to do is probably help you with some perspective on how do you approach this in the first place? What's the best way to do it? What does research say? What do most of the experts talk about? And what most experts talk about and what you should know is that when you are thinking about protecting the money that you have and growing your wealth, the simplest rule that you can take advantage of is to diversify your money into different baskets that you buy into. It's just like that old grandmother's saying that don't put all your eggs in one basket. You've got to spread your risk and put your eggs into different baskets. So similarly, it's the same rule that applies to money. It is best that you should diversify your money into multiple buckets. This is a very odd one. I've had this conversation with my daughter sometimes, and she says, what, the richest people like Elon Musk, or whether it is Bill Gates, or whether it's Oprah Winfrey, Warren Buffett, they've all made money with concentration. They've not diversified. Either they've got stocks in their company and that's what's helped them grow rich. And which is true, actually, that, immense wealth, multiple times of wealth, many a time get created because of concentration in just one stock or one idea. That can happen. But it's an exception rather than the rule. And I think that's how to think about it for most of us who may not be able to take that kind of leap of faith and who want to ensure that our financial lives are smooth. Then it's not concentration, but you could, spread your money across different baskets. And that is the best way to both protect your money and to grow your money. So there are 7 baskets that can help you do this, according to me. And it doesn't matter whether you're in the US or you're in China or you're in India, Japan, wherever you may be in the world. I think that, there's going to be these, 7 asset classes that you can think about. What are those 7 asset classes? The first asset class is equity. The second basket is bonds and debentures of companies which have a certain fixed rate of return. You can put fixed deposits in that basket as well. The third basket is gold and precious metals that you can invest into. The fourth basket is other commodities. You would have heard people investing into cotton and, things like that, into commodities. You can actually do that. So that's the fourth basket. The fifth basket is real estate. You've got residential or commercial, or you can buy land. So the fifth. Sixth is currency. You can make money off currency as well. There's some people who say, hey, that's not really a great basket. But I do think that there is enough people who do accept that, yes, you should have an exposure to currency as well in your portfolio because you can take advantage of that. And the seventh basket is what I called alternates. Alternates is that basket where you put all of those things that you can actually invest, and people do make investments, but you don't get public data on the internet easily to compare your investments with anything else over long periods of time, just to understand, hey, how is this going to function if the market is going up or down, and how does it function against equity? How does it do against gold? You want to compare to see certain things about how they do, and you will never get the data that you want for anything in this basket called alternates. And I'll give you some examples. Private equity funds, or hedge funds, or venture capital funds, or Bitcoin. For instance, I would put it into the alternate basket because you need 20 to 30 year data to compare something with something else so that you know how safe or how good that is and what to expect during different times in the market. It's too young, and so it doesn't have that kind of data. So I would put that into alternates. Same thing with, investing in paintings or antiques and things like that. Things that don't have public data for 20 or 30 years that you can use to compare against other investment options that you have. Put all of that into this bucket called alternates. So what are the 7 buckets? Equity stocks or equity mutual funds. Second bucket is bonds and debentures, debt mutual funds, fixed deposits. Third is gold and precious metals. Fourth is commodities. Fifth is real estate. Sixth is currency. And seventh is this bucket called alternates. And the idea is really that, when you should spread your money in as much of this as possible, as much of these 7 buckets as possible. I personally believe that mutual funds as an industry and a category is fantastic for you to try and get exposure to as many of these asset classes as possible. You have equity funds, you have debt funds, you have international funds that can give you access to currency as well and exposure to currency as well. There are real estate exposure related funds that you can take, whether they're rate funds or, thematic products that might have real estate as it. Very few commodity funds though, but you can do that. And of course, there are gold funds as well that's available. So imagine you could actually, use mutual funds very effectively to spread your money into these different asset classes. I don't think that there is any specific thumb rule to say, how much should be your money in each of these assets. I did talk about thumb rules in my earlier podcast, and the only one that I gave you there was 100 minus age for your investment in equity. If you look at my personal investments, for instance, because I do use a financial advisor, I have been doing that for the longest time. I would advise everybody always to have a trusted advisor because your financial situation is unique. In my case, for instance, my equity exposure is about 53%, but I've got 25% in debt. I've got 17% around in real estate, 4% in international funds, and 1% in gold. That makes up my 100% portfolio because I have financial goals that I and my financial advisor have discussed. And this is the portfolio that suits me. And roughly, as you can see, the equity is, 100 minus age. I'm 52, and it's somewhere around the same region that I have exposure to equity as well. So I hope the 7 asset classes is something that you will remember to diversify your money into. That's always the safest way to both protect your money and also create wealth. Guys, that's it. That's the 7 asset classes that you can think about for diversifying your money. And I hope that you found that reasonably simple to think about and have as a perspective as you go on your financial journey. Thank you very much and see you in my next podcast. Bye-bye.
Well, who knew? 7 asset classes and you could have your investments pretty much sorted. Thank you so much, Ajit, for that lucid explanation. So just a quick recap. We learned that optimal asset allocation can be achieved by having the right mix of equity mutual funds, debt funds, precious metals like gold and silver, commodities, real estate, currency, and finally, alternates in your portfolio. Now, of course, this would depend on your investment objectives, so be sure that your asset allocation and your objectives are aligned with each other. But for now, that's a wrap on this edition of Money Buddy, our very own podcast series here at PGIM India Mutual Fund. Stay tuned for more such insights and also be sure to check out our other podcasts in the future. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Money Buddy podcast brought to you by Money and Me, an investor education initiative by PGIM India Mutual Fund.